These are the worst mistakes you can make as a beginner investor. Number one, we have chasing the dividend yield. Having your investments pay you large dividends or yield sounds amazing. It's truly passive income, where money just shows up in your account without you having to do anything.
Tell them to bring me my money.
But what if you get too focused on maximizing dividends or yield in your portfolio? After all, there is no free lunch when it comes to investing. There are always trade-offs, and it turns out that there are some pretty significant disadvantages for investors who try to maximize their yield or dividends at all costs. And it can result in you actually getting substantially lower total returns over time. For example, BCE or Bell yields 9% right now, but it's down 26% year to date and 28% over the last 5 years. And its dividend takes up almost all of its free cash flow. The company can't even take that money and reinvest it into the company. They have to pay it out as a dividend. So they're in debt, for one, and they can't get out of it because they're stuck paying this dividend. And yes, they could cut the dividend, but for Bell, the whole reason people invest in Bell is for the dividend. So if they cut that dividend, they're going to lose investors all over the place. So it's kind of a catch-22.
Catch-22. Yes.
And number two, we have not diversifying. Don't put all your eggs in one basket. This gives you a little protection from risk, but you also don't want to dilute and over-diversify by having like 30 holdings in your portfolio. My rule of thumb is only invest in companies you understand and believe have a strong future. And number three, we have not investing enough or starting too late. At least 15% of your take-home pay should be going into your retirement at any age. As soon as you're 18, and the earlier you start, the better. If you wait until your 30s though, that number goes up pretty quickly because you're losing time on your investments to compound. Like if you have $0 in your retirement in your 30s, you'll probably have to start putting bare minimum 20-25% of your income to retirement. So start as early as you can. Don't make that mistake. And number four is not doing enough research and paying high fees. Paying crazy fees for mutual funds and ETFs can drastically hurt your overall returns.
I declare bankruptcy!
Make sure you know what the fees are before you put your money in a mutual fund or ETF. And do your research. Just because a stock is up 25% in the last week doesn't mean it will be up 25% again this next week. Figure out why it happened, how the business works, and make an educated decision before you invest. It's never going to be perfect time to start investing. You might think, I only have $20. That's not going to make a difference. Do it. Get into the market, get your toes wet. Trust me, it'll make all the difference. Thank you guys so much for watching. If you made it all the way to the end of the video, make sure to hit like and subscribe, and I'll see you guys in the next one.